All right, welcome to this month's market update. First off, a well-earned congratulations to the world champions of baseball, the Los Angeles Dodgers. Long time coming since those stealing, cheating Astros in 2017 took the title from us when I feel like we really should have won it. But I digress. Let's talk a little bit about what we're going to go over this session. First off, we're going to go over the economy, we're going to go over unemployment, we're going to go over forbearances and foreclosures, and then we're going to dive into some of the national numbers and then break it down into the more local numbers, including single family condos, and we're going to take a look at rentals as they are going to have an impact on the market coming up in the near future. Los Angeles on its own is its own kind of market. Please remember that when we look at national numbers that it all comes down to that real estate is hyper-local. Being hyper-local means that we have to look at the local numbers and how it affects us locally, not just on a national scale and taking those numbers. That said, let's jump right in. Okay, so to start off, we're going to start with the economy. Now, you may remember, those of you who have been playing the home game and watching from home, the April monthly market report, we talked a little bit about the Goldman Sachs, JP Morgan, and Morgan Stanley GDP V-type recovery. Well, we're into it now, and what type of recovery have we had? The actual GDP numbers are exactly as predicted. We have come out of this exactly as it was stated by those institutions. Now, news stories often describe the coronavirus-induced global economic downturn as the worst since the Great Depression, yet for many, the comparison does nothing more than to terrify than clarify. And that is Josh Zumbrun at WSJ. Taking a look at something a little bit different this time. We're going to look at FICO scores. What has happened to the average person's FICO score over the course of this pandemic? It actually has risen. And there's some scratching heads on this, but they figured it out. Basically, what was happening is that the households that use most of their stimulus checks to pay down their debt and save. Well, this is fantastic. That means that over 70% paid down debt and saved the money. That's really good. That means that 29% spent it because they had to for whatever reason and necessities and the cost of living. We have seen a change in consumer spending. The consumer spending is rising overall, although we are still under where we were before we started this, but we're seeing growth in the consumer spending department. We'll see how the Christmas sales go. The United States on the whole is 3.7% under what it was pre-pandemic. This is a good sign. It means we're making progress back into the realm that we need to be of consumer spending and durable goods and orders. Unemployment, our favorite subject here. Overall, the unemployment rate, number of filings that have been happening have been decreasing. We have kind of plateaued here. Theoretically, without jumping into the numbers, I'm going to assume that it has a lot to do with certain industries not being able to make it back. Some schools, hospitality sector has not recovered at all at this point. It's still the messenger's out on that one. We don't know what's going to happen. Here in Los Angeles, that is a major factor as we are a hospitality industry driven town with tourism and the entertainment industry, and both of those have still not made it back. So it's very relative, but on a weekly basis right now, we're seeing about 750,000 filings for unemployment. As far as the currently receiving, we have about 7.3 currently receiving unemployment. Now, I just pulled these numbers as well. This is the Los Angeles unemployment rate right here. That's sitting around 15.1%. The national unemployment rate is sitting around 6.9 for October. That's not the adjusted to the most recent. That is the adjusted for October. When we look at data from the Survey of Business Uncertainty, the SBU, suggests that the road forward is going to be a tough slog. Businesses hold tepid expectations for a year ahead, employment and sales growth. Expectations are in fact so tepid that based on the latest average projection, it will take firms more than 4.5 years to recover from their pre-COVID employment levels. That's the Federal Reserve Bank. I have my own opinions on that. I feel like there are some things that are going to happen from the federal standpoint that's going to reduce that number much faster, much more rapidly. I'll be blatant. I think that we're going to get infrastructure projects. Some of our infrastructure is well over 100 years old and needs to be replaced. So I do see that coming into play. That it doesn't matter which administration you look at; they're both talking about it, have been. And I'm sure that that's going to come into play. So we will see how that plays out. But I don't think that this is going to last personally. That's my opinion, if you will. The number of mortgages in active forbearance decreased dramatically over the past couple of months. We have seen it kind of flatten out, but month by month, it has dropped incrementally. This is a good sign. This means that the number of mortgages in forbearance is decreasing rapidly, which means that people are either able to come out of it because of employment reasons, they're back at work and they can afford to pay their mortgage again, or they're able to sell because they had so much equity, and the market is so robust right now for sales that they can easily get out of it without having to go to foreclosure. So when we look at the percentage of overall forbearances, those are decreasing. We can see we were in the 8s, then 7s, and then the 6s, and now we're in the 5s. So this is great progress forward as far as avoiding any kind of major housing fallout. These numbers are typically on housing, not on commercial properties. Different area over there. Okay, of the 5,760,000 families that are granted forbearances on their mortgages, we've seen about 2.4 have had their forbearances extended. And out of that, 2.3 have removed from forbearance. Now, this could be any kind of action. It could be they just got back to work and went back and started paying their note again, and that's what we would hope would happen and expect. About 500,000 paid off their mortgage. Now, what does that mean? Well, it could mean that they probably sold and they just sold their properties outright, said we can't afford this, but we can sell and we can walk away from it and have some cash in our pockets, and that's exactly what most people have been doing in these scenarios. As far as expired, delinquent, and loss mitigation and expired and delinquent, we have about 530,000 homes that have mortgages that are in that category. Overall, 44% have either removed while performing, meaning that they started paying, or they sold, or they paid off their mortgage. So these are great numbers and great signs for the future as well. The likelihood of us having a foreclosure crisis again is about 0%. Guys, I've been saying it all along. The company that I get these analytics from, they've been calling it all along. It's just there's too much equity in the market. There is no way we're having a foreclosure crisis. So for those of you who are holding out for it, you better get on the bandwagon and start buying, because that's where pricing is going. Let's jump into the update and we'll get into some of those numbers. So, months of inventory for homes for sale. You can see that we are just at drastic lows in the amount of inventory that's available for homes for sale. It's been a real squeeze, and it's continuing. The year-over-year change in listings, when you see the total listings versus the new listings, we are just still not seeing that many listings on the market. This is from move.com. The top 3 reasons why homeowners are not putting their house on the market right now is 34% are saying life is just too uncertain right now. 31% is saying financial uncertainty, and 25% says COVID-19 health concerns. Okay, so out of the ones that are going to plausibly sell, the ones who really could move forward, who could make that jump, who need to do the house upgrade or the downgrade, it's probably a good time to take advantage of it, because pricing is going to rise. So homeowners who feel like life is uncertain right now may think that they can still get a strong price if they delay selling until they have more clarity. The catch is that waiting to sell may raise the cost of a trade-up. This fall's record low mortgage rates, which make a trade-up more affordable on a monthly basis, are not guaranteed to last. And this is from Jeff Tucker, senior economist at Zillow. Now, projection of home price appreciations, you can see that Zillow has adjusted up again. Zelman, Freddie Mac, NAR, HPES, MBA are all upgrading what their home price appreciation is going to be. CoreLogic, at least, is no longer negative. They're making progress. We give them a golf clap. Moving on. The MBA forecast for 2021 for rising mortgage rates, they're forecasting a little bit differently than some of the numbers that we've talked about in the past. They are saying that by 2023, we're going to be back up to where we were at pre-pandemic levels, just above at 3.9%. So this is something to keep in mind, that the monthly affordability is right now and may not be there in the future with pricing. So as far as the Housing Affordability Index, this is a measurement by NAR that determines how affordable houses are. You can see where there was distressed property, and then you can also see where we are just kind of normalized, but the affordability is extremely high still. The good news is that affordability remains significantly higher than 1 year ago, mostly due to falling rates. 1 month does not make a trend, but this month's decline in affordability signals that the current dynamics producing faster house price appreciation may begin to erode the affordability of gains of recent years. This is Mark Fleming at First American. So that's it. Where do we stand? Well, we're going to jump into Los Angeles numbers now because we want to really take a hard look at what is happening here with single family condos especially. And the rental properties. But I think we're going to find some interesting stuff here. As you can see, on a national scale, just as much as here, there are a number of active listings, but it's not enough to satiate the market right now. We are still at lows. 10,132. That's a decline year over year, or a month over month. That means last November, there were 21% more listings than there are today. That is a huge number. It means that things are really tight. Single family pending sales have also fallen off. Part of the reason why is lack of inventory or sellers not negotiating prices with buyers. Those are usually the two reasons, but I'm going to go with lack of inventory that buyers are willing to purchase. We will see what happens next month, as this was an election year. It may pop back. But for right now, pending sales have fallen off. These numbers from October also had closed sales rising at 9% year over year, meaning last October we had 9% more home sales than last October at 4,678. The number of active listings versus closed sales, you can see that the active listings continues to stay low. That's the top bar. And then the bottom bar is the closed sales. They tend to stay at the top end of the range. So we're consistently seeing some movement in the market, just not enough inventory to really fill it all. The single family median sales price rose again last month. And again, I'm attributing this to lack of inventory and high competition. It rose 21% year over year to 823,500 for LA County. That's a big jump, people. That's a really big jump. Single family average price per square foot trimmed back a little bit, but still up 13 to 14% year over year. As far as looking at the average price per square foot by price range, this is one of those fun little charts I started doing. I wanted you to just kind of observe that the bottom line is 1 million or less and has slowly been rising over time, but we've seen it accelerate some since COVID began. The 1 million to 2 million range has pretty much stayed in the same range that it was before. The 2 million to 5 million range has ping-ponged around. It recovered and looks like all of them are starting to pare back a little bit. And the 5 million or more is just languishing on the market. We are not seeing much movement on a price per square foot average in that sector. The month supply for single family housing, this is again one of my favorite indicators, is right now closer to 3%. This is a 12% decrease year over year, meaning last year we had more supply. We still don't have enough supply. That said, I think that we have a shadow inventory of about 0.3 months worth of shadow inventory, probably like 1,500, 1,600 listings out there that keep on going on and off the market trying to sell but can't. So we will see how that kind of transitions forward into the future. As far as the kind of pulling it all together here, this is one of my favorite charts right now because it kind of demonstrates everything. When you look at the active listings in the middle, that's the number of homes for sale. And you can see the closed on the bottom, which we looked at before. But now we're looking at the average per square foot. The tight inventory has been driving the average price per square foot up dramatically. And I think we can see it here. It's just been skyrocketing. It is hitting new highs and no telling when it's going to come back down. If you follow what we discussed earlier in this market update, it's probably going to continue, which means that home prices are going to continue to rise over the next couple of years. Condos active listings have continued to rise. We are 20% more condo inventory than we did last year. We are at 3,662 active listings in October currently. The pending sales has fallen off. We went down by 35% year over year as far as pending sales. And the closed sales, however, the bright spot, many did actually close a bunch of sales. So we are actually up 20% on the closed sales side. What does that mean? Well, there's a gap there, I'm sure. But the median sales price seems to be holding. It's about 2.2% year over year gain at $516,000 for the average condo in Los Angeles County. The average price per square foot is continuing to sit at about $516 per square foot, and that is a 0.4 year over year increase. The average price per square foot by price range. Now this one is fun this month because somewhere along the way, I have not dug it up, but look at that 1 million or more condo mark. There have been a batch of sales, and I have to wonder if it wasn't a high-end luxury tower that finally recorded its sales. I'll need to dig this up, but it just shot the average price per square foot through the roof. This is an outlier. This is what we call, I don't know how or what caused this, but I need to dig into it and find it. I didn't have time to check the numbers. Overall, condo pricing is falling. You can see that that is drifting downward for each category, 500 and under, 500, 750, 750 to $1 million. All of those are drifting downward. And this is going to be probably due to the massive amount of inventory that is accumulating right now in the condo market. As far as month supply, you can see that we're at 4.4, 4.5 almost. That's a 25% year over year increase in supply. My hunch is that this trend is going to continue through the winter. It is becoming increasingly apparent that we're starting to feel like more like a buyer's market for condos, and that sellers are going to have to adjust to this type of new normal when it comes to condos, which is kind of a parallel when you think about it between the single family. The single family is doing extremely well and condos are not. Why? People want more space, and condos have traditionally been first-time buyer or, older couples or work professionals who don't need a single-family home. But we do have a lot of families who are hungry for one right now, and they're out there and buying. So, kind of tale of two cities for fun. Let's take a look at the lease for rent market. This is an extremely important part of the conversation right now, and the reason why is because when we look at this, we have seen an increase in the number of places available for rent, a 5,000 almost number increase. So where did that increase come in? Well, we're seeing a swell in condos and townhome rentals, and we're also seeing a slight swell in the number of houses. Apartments climbed as well. So combining all those little incremental, there's more on the market, we have a lot more on the market that's available for lease. If we get into a lockdown situation again, I expect this number to increase even more. So everybody be good, wash your handsies, wear your maskies when you need to, and definitely, let's all be careful and see if we can't curb this thing, because right now it looks like it's going to spike, which means Los Angeles may get locked down again. So be careful. Hope you enjoyed this market update. If you have any questions, please let me know. I am happy to take a look at any specific neighborhoods or your home or neighborhood if you like. My name is Dennis Maynard, and that was November's Los Angeles market update. Take care.